Hey guys, thanks for jumping back into the cryptoverse. Today we're going to be talking about Ethereum. We're going to be looking at risk analysis and providing an update. If you guys like this content, please subscribe to the channel and turn notifications on and like the video. And also feel free to check out the Telegram and Discord channels in the description below. I think the Telegram channel is approaching 1,500 members, so if you want to discuss ideas there about these data science models, then feel free to join. So what we're going to be looking at is we've provided this risk analysis for Ethereum maybe 1 or 2 months ago. I don't remember exactly when I posted it on here, but we have the price of Ethereum on the primary y-axis over here, and it's also a log scale. So for those unfamiliar with log scales, 10 to the 0 is 1, so this would be $1, and then 10 to the 1 is $10, 10 squared is 100, 10 cubed is 1,000, 10 to the 4 is 10,000. And then the grid lines correspond with the primary y-axis. Now the secondary, or I should say the color bar over here, goes from 0 to 1. And it's a risk indicator that I made. Now if it's dark blue, then the risk is 0. And if it's dark red, then the risk is 1. And basically, dark red means very high risk. So if it's 1, it's a very high risk time to get in, meaning you likely want to be selling. And if it's dark blue, it's historically a good time to get into the market, meaning you probably want to be buying. Now, this is not financial advice. This is just an indicator that I use myself when trying to determine long-term momentum shifts in the market. So, what we have here is, as you can see, this looks pretty similar to Bitcoin in the early days. We have this initial run up where it actually got to dark red, and notice that this run up here had a higher risk associated with it than this one did, and it's just an artifact of how quickly it moved up. And even with Bitcoin, this is something that is taken into consideration. Now, the difference between this risk indicator and the one that I use for Bitcoin is the one for Bitcoin is a little bit more sophisticated because there's a lot more data to sample. So it accounts for diminishing ROI. It accounts for just the time it takes to see that diminishing ROI. Whereas Ethereum, we don't have as much data to work with, so it's a little bit simpler. So with that said, with the Ethereum risk indicator, in the future, I likely would be selling everything if the risk ever popped above, say, 0.8. Above 0.7, above 0.8, I'm going to be mostly out of the market at that point, just because this is not accounting for maturation of the asset. Now, if we look into this model, you can see that the risk hit its lowest point over here in December of 2018. And currently the risk is it's not the lowest it's ever been, but it's currently around 0.338. So that might be important to you if you've developed your own method of where you might be buying and where you might be selling. So when I showed this color bar, it's obviously hard to tell the exact numerical value, so I like to also draw the risk indicator on a secondary y-axis. So the white line is the price, and it corresponds to the primary y-axis over here, and this orange line is the risk, and it corresponds to this axis over here. So you can see how it goes, it goes all the way up, and then it went all the way down. Down to close to 0, and now we're moving back up. And then we moved back up throughout 2019, throughout the first half, and then through the second half, we basically went from a risk of maybe around 0.45 or so down to say 0.3. And now where you choose to buy, so the risk that you choose to take is obviously up to you. Now, there are people out there that will claim to tell you, exactly when you should enter the market and exactly when you should exit. Now, this is not what this channel tries to do. We try to talk about these longer term shifts and how you can dollar cost average your way into a market as well as dollar cost average your way out. So a lot of people have this mentality of I have to sell everything whenever I do sell. But when they buy, they don't have that same mentality. They'll dollar cost average their buys but they don't dollar cost average their sells. So this is an important aspect to take away, is that you're most likely not going to be the one person who sells the top, the very top, and it's just not going to happen. And if you can admit to yourself that that's not going to happen, then it becomes easier to dollar cost average your sells. Would you rather sell, let's say Ethereum in the next bull run were to say peak at, let's just say $5,000. Maybe you would sell some at 1,000 and 2,000, 3,000 and 4,000 and 5,000, and maybe your average sell is, let's say it's around $3,000. That's still doing quite remarkable. And a lot of people will just they'll hold everything up to 5,000, and then they think it's going to 10,000. They watch it drop 50% in a month or a week. It goes down to 2,500, and then they become in denial that it's just a correction, and this is the typical denial mode of people in a speculative bubble. I mean, I've seen so many of them. I was a part of a lot of speculative bubbles in 2019, and I learned my lessons in years past, so I knew when to get out. And one of the ways you know how to get out is if you just post anything, or you say anything that isn't exactly roses about the project, and if everyone just labels it as FUD and just wants to kick you out, it's probably time to just get out of the market. So the thing with that is, I know I'm going off a little bit here, but the thing to remember is that the social part of the markets, the market sentiment is also a really good indicator for the market conditions. So I also do use that to slightly inform what I'm going to do. I mean, if everyone is just FOMOing in and buying like crazy, then it also is likely going to be corresponding to a risk of something way up here. So let's just keep moving forward, because I want to, we covered some of these things in the Bitcoin video that I published yesterday. So if you haven't seen that one, you should go watch it. But we've talked about different types of investors, and I'm not going to go through all of them here that I went through yesterday, but I will just touch on some of them because I know some people just watch the Ethereum videos. So one type of investor that we have is the aggressive and dynamic dollar cost average investor. So this is someone who is not, they're trying to be a little bit wittier with their buys. So when the risk is higher, now obviously they're not using this risk indicator because this is mine, but I mean, it's not that difficult to just create something yourself to define as risk. But they might, dollar cost average less up here, and when we're all the way down here, maybe they're dollar cost averaging more. So as the price continues to drop rapidly, they're likely putting more into the market when the fear is high, and as the fear subsides and the greed starts kicking in, if they are still buying, then they're buying less. And the reason I call this the aggressive investor is because they're investing to very considerably high risk levels. Upwards of say between even 0.6 and 0.7, which if you're investing at this point, then it's more or less, all of cryptocurrency is speculative, but I would tend to say that stuff down here is more of a long-term investment. And investing when the risk is up here, that is just super speculative, that just within the next few weeks you think there's going to be a blow off top, and you're just hoping to basically squeeze whatever you can out of the market. So this is more of a long-term investment. Buying up here, as I said, is more speculative gambling in a sense, and just hoping that it continues to shoot up in the short term. So what we're going to be looking at here is these different types of investors. So we also have the moderate and dynamic dollar cost average investors. So this is potentially if you're buying, say, at risks between 0 and 0.5, and you're dollar cost averaging your way in, but you're putting in different amounts as the price is getting lower and lower, and as the risk is also getting lower and lower. Now I should point out that the lowest price obviously does not always correspond to the lowest risk. I mean, if I just go back to this over here, I mean the price here is significantly lower than it was over here, but yet the risk was higher here. So obviously you can't just correlate the price to the risk. It's how it gets to that price and how quickly it gets to that price. So we also have this idea of, well, you've bought Ethereum and you've been buying it for years. Let's say you've been buying it ever since let's say February of 2018, or even maybe you started buying even further on. Maybe you started buying in January and you're one of the ones that bought at $1,400. But let's say you've just been buying, and maybe you bought a little bit up here, but you're putting in 5 times the amount when the risk was, between 0 and 0.1. And let's say you did this for 2-3 years, and by the time the risk gets back above, say, 0.5, maybe that is your threshold for selling. Maybe you start selling. Now, a lot of people will say, oh, the risk, maybe it gets into this region, should I sell everything? And, while you can sell everything, that is completely up to you. That's not what I'm doing. I would say I would not sell everything the minute the risk gets into a sell band that you're comfortable with, unless that sell band is, say, like, 0.8 or 0.9 or higher. Then, I mean, at that point you're just playing with matches in a sense if you're just holding everything. But one thing you could do is, let's suppose you've accumulated 100 Ethereum during these, during, say, these couple of years. You could sell them, you could sell 20 when the risk is in this region, 20 here, 20 here, 20 here, and 20 here. And if, let's suppose that we don't make it up to this risk band over here, or let's say we don't make it up to a risk between 0.9 and 1, then you would have sold 20 between 0.5 and 0.6, 20 between 0.6 and 0.7, 20 between 0.7 and 0.8. And then you could have just, you could have sold back on the way down. So this is one way to do it. And at this point, you would have sold 60 Ethereum on the way up, and maybe you would have sold a little bit more on the way down. But the point is that you would have sold a majority position of your Ethereum, and maybe you're holding on to 20 or 30 Ethereum, but you can look back on it and say, I sold 70 to 80% of my position at a price that was 10 times higher than what I bought it for. I'm going to count that as a win and move on. I'm going to not be mad that I held on to the extra 20 because I didn't know for sure that it wasn't going to go higher. Now, if it did go higher, you could have continued to sell. Now, this method obviously does not appeal to everyone. Some people, they want to push that risk further, and obviously if they consider between, say, 0.5 and 0.7 a buy region in and of itself, then maybe they're still buying in this region. But another way to look at it is you could sell a small percentage at this risk because it's a relatively low risk compared to what it historically has been. And then as it goes up, you could continue to sell more and more. So you could sell 5 and 10, 20, 40, and then maybe 25, the last of your stack if it ever were to reach that point. Now, again, as I said, I don't think that using this specific risk model for Ethereum will ever get us back to between 0.9 and 1. I've tried optimizing it. I'm going to keep trying to see if I get something that I'm satisfied with. But until that time comes, just bear in mind that most likely the next blow off top for Ethereum, considering diminishing returns, would maybe see our risk peak at between, say, 0.7 and 0.9, somewhere in there. So, considering selling when it gets to these levels is not necessarily a bad move. And one of the nice things about it is, you first have to change your mentality. If you're able to sell, let's say you just sell 5 if you have 100 and you sell 5%, then if the price continues to go up, then you can just keep selling and you can be happy about that. And if the price goes down and it goes back into this buy region, then you can take whatever profits you took and reinvest it into Ethereum and then grow your stack. It's basically having to admit to yourself that you don't again know exactly where to sell, and you don't exactly know where the best place to buy is, but by dollar cost averaging both, it will usually work out to your benefit. And the only thing that you really have to think about is time. In the cryptocurrency market, if you believe that it's going up in the long run and you believe that Ethereum is going up in the long run, then time is your friend. Just become more disciplined in your longer term positions, and don't bring in emotion to it. Just look at where the risk is. If we were to go down from here, if the risk were to say drop to zero point 0.1, which clearly would mean that the price took a nosedive, I would say treat that as an opportunity, because this was a huge opportunity over here, and this was when a lot of people were probably selling. And look what happened. I mean, you could have made about 3 or 4x in the short term. It's when there's fear in the market that is the most appealing to me, because you want to be buying into the fear. So let's continue moving forward. This is what I think a majority of people are, the aggressive and static dollar cost average investors. So they just, they set aside a certain amount every paycheck, and they just put that into the market, and that's fine. Being a dynamic dollar cost average investor requires a bit more patience and a bit more restraint, because let's say your monthly budget is, say, $500, and you're over here. Maybe you just want to put in all 500, but you could come up with a plan to say, you know what, I'm going to put in 200. I'm going to put in the rest into, say, a stable coin and earn interest on it through decentralized finance. And you could just move forward like that. And then if it were to come down here, then if your monthly budget is 500, then you only put 400. So then you've banked 300 from here and 100 from here. That is now $400. And maybe you've earned interest on it, and maybe it's at, say, $450, or let's say $500, just for simplicity. I don't, depends on how long, obviously, you have it. You're accruing interest on it. When you get down here, your monthly budget is only $500, but you've already banked an extra $400 or $500 from not doing it over here. And then down here, and this would follow that same pattern. So then, despite the fact that on average you're only putting in $500 a month, you're putting in more as the risk goes down. And obviously there is risk in that, because if you were to just to pop back up over here, you have to be okay not putting quite as much. So it requires patience, and it requires the acknowledgement that it might not ultimately be the best thing, but it's my strategy that I'm going to stick with no matter what. So this is an aggressive dollar cost average investor, meaning you're buying even into high risk levels, and you're just putting in the same amount every single month. Now, one of the things I would like to point out is I just wanted to compare this with Bitcoin. So you can see, again, this over here looks pretty similar to Bitcoin. And one of the things that I will be optimizing with Ethereum, hopefully in the next several months, again, is just making it look a bit more like Bitcoin, where this becomes a darker red. But it's hard, just because there really isn't that much data. So as we get more and more data, I will keep playing with the model to see if I can get a better version. But until then, I think this one serves its purpose. Just remember, the ramifications. I think it's a really good buy model. I think it's a good indicator for when to buy. It's just that with selling, you're going to have to be a little bit more cautious and thinking that it might not ever get up to that 0.9 to 1 risk level. So I think that'll wrap it up for the analysis. Now, I did want to mention that in the last Bitcoin video, I did show my dog, and people were asking, or I was polling people on what they thought she was a mix of, and a lot of people got it right, and I'm sure you can actually see her. She's right here. But in this, I was just gonna see if anyone could guess what her name is. She's 6 years old, but I named her after a country, or I named her after a city/town in Africa. So if you think you might have an idea just throw out some guesses. Let me know what you guys think. So finally, I'm sure many people want to know the future of these risk indicators. So ultimately, I think the goal would be to put them in TradingView, or make them an indicator in TradingView, and have it be some type of model where you can just pull up at your leisure and just look to see where the risk is, and make your own judgment. But until I put it in there, and I haven't fully decided if that's what I want to do, if I just want to put it on my own website. But if you are looking for every updates every, say, 2 or 3 days, then I do have a Patreon channel, and I know I've mentioned this in several videos. But if you want to join the Patreon channel, you can see it here. It's just patreon.com/intothecryptoverse, and if you wanna join this, you can just join the $30 a month tier, and you'll get these patron only updates. And this is where I provide risk updates. I usually do them at request, and or every 2 or 3 days, just so that everyone knows where the risk level stands. So if you want to join this tier, you will also get access to a patron only chat room where we'll talk a little bit higher level about some of the stuff that I'm doing, and then if you want, you'll also get the subscription to the full edition of Bitcoin Letters. So this was first released this month for free, and if you're curious as to what it looks like, this is what it looks like. It was 21 pages, and you can see we talk about a ton of different stuff. We talk about return on investment. We talk about your ROI for 90 days and 1 year, and this is broken up by month. This is your ROI based on basically how long you would have had to wait to see different return on your investments. We go into market cycle return on investment from each market cycle bottom. We look at the arguments for the 4-year cycle and against the 4-year cycle. We look at risk management for Bitcoin. We look at how you can sell and buy at various regions. We talk about logarithmic regression, some of the benefits to using it, some of the constraints that it has, and then we show these fits to different logarithmic regression curves. We look at decreasing volatility and try to use this volatility to estimate upper and lower annualized volatility. We look at derivatives from calculus. Many people probably we're hoping they never have to think about again. We look at comparisons between the S&P 500, and then we also, if you haven't checked out this website, go check it out. It's still in development. It's still really early on, but it's intothecryptocharts.com. So we have some live updated charts there, and then we look at the total cryptocurrency market cap, and as well we report on Twitter polls. So this was Bitcoin Letters, and in February we're going to come out with Ethereum Letters. Now it's not going to be 21 pages. I was really I made it a goal to get to 21, just out of respect for Bitcoin. But if you wanted to subscribe to Ethereum Letters, I will be providing a abbreviated version for free, and it'll just go over some of the charts. Not all of them, but it'll go over some of them. And if you want to receive the full edition, then just subscribe to the $50 a month membership level, and you will get a subscription to Ethereum Letters, as well as a subscription to altcoin letters, which will come out in March. And this will be on a lot of the coins in the top 10, as well as some other coins in there as well. And if you're wondering which coins it'll be, or if you want to say throw in a coin that you would like to see added, just join this $50 tier, and I will try to I'll field requests from this $50 tier. I'll make polls and whatnot, and try to get an idea of what people really want to see and what they want me to focus on. So obviously I'll be focusing on many in the top 10. There's certainly coins in the top 10 that I will not focus on. Obviously Tether is one. I will not focus on that. It's a stable coin, but not all of the others, but most of the others I will go over in the top 10, and then some other sprinkled ones that are, say, in the top 100. So again, feel free to join that if you so desire. I think that wraps it up for this video. If you guys like this content, again, please subscribe to the channel and turn notifications on and like the video, and also check out Telegram and Discord. And then finally, I don't really talk about my Twitter, but if you do want to join my Twitter account, feel free to, or if you want to follow me on Twitter, I should say, you can do that, and I'll always put updates there as to anything I post, and also I'll do polls and whatnot from there as well, and just make some other statements every once in a while. So if you want to follow me on Twitter, feel free to do that. It's just into Cryptoverse. And also, if you wanted to look at this report, just go to intothecryptoverse.com, and you can basically just find it from there. So I'll just show you really quick how to do it. So intothecryptoverse.com, you would just click on reports. So we also have charts and videos, and that will take you to these reports. So you could just click on, say, Bitcoin, and go to the first edition, and then here it is. And you could even download it if you want, and then it'll pop up and you can read all about it. It's 21 pages. So again, I think that'll wrap it up for this video. Thanks for tuning in, and I will talk to you guys next time. Bye.